All right, yield nerds, as we talked about the previous time, about a week ago, we're going to start learning about value investing. Now, what does it mean? And many times it is a common knowledge that the least read textbook in investing is the history textbook, and we're not going to make that mistake. We're going to start looking at macroeconomics, which is a broad perspective of what happens in the economics, and we're going to read history. So let's talk more about it. And before I dive deeper, my usual disclaimers: I do not have an agenda other than to educate you. I learn as much through this process. I just happen to document my learnings and present it to you, and I appreciate your comments. I don't have any product to pitch. I'm not sponsored, and I'm not here to espouse any political opinion. In terms of following the show itself, some of you may know that there is a playlist. It is available right there. The playlist organizes this entire show in a sequence. So if you're jumping directly into value investing and you want to pick up from a topic before or two topics before, or if you're a middle school student who wants to learn about investing, we pretty much start at that level. Go to episode 1 and you will see how to do it. I've also enclosed this video right here, which explains how to even think through the show itself. All right. On this specific episode, we're first going to see why it is that we're even looking at value investing now and define what it is. Look at the history textbook and look at macroeconomics, because that is the foundation of the whole thesis, and then create a framework for value analysis. So the basis, meaning our truths, what we believe in, is that the treasury being the king of investments, that game is about to be over. Yields will drop, and they have dropped significantly, but they'll drop even more to a point where you can't just get the kind of dividends you were getting, kind of get the interest payments you were getting with just investing in short-term treasuries. So you have to start looking for other opportunities. To get 5% yield used to be you just put money in 3-month treasury, 6 months, 9 months, and some agencies paid 6.5%. Those days are gone. So you need to start looking at equities, but there is also the debt ceiling issue that is coming up in 90 days or so. And all that is telling us is we need to cautiously understand what kind of equities are lower risk that offer a reasonable return, but probably think about also the timing of when to get in. So let's talk about the economy, which is the basis of this thesis. We do have inflation. The myth that inflation is dying is certainly not being espoused. It's dropping, inflation is dropping, but it's going from 6.2% to 6.1%. That's still a lot. Nowhere close to the 2% target. We do have interest rates that are going up. It went up by 0.25% a couple of weeks ago, and it may go up some more. Even if it doesn't go up, it may stay steady before it declines. And so the idea being that we do have reasonably high interest rates and still high inflation, that creates a dangerous situation called stagflation, where the economy doesn't grow enough, but inflation persists, which means you need to make your money work harder. And that is why we need to think about this some more. And the reality in terms of inflation or interest rates, this stuff has happened in the history books of the United States before. All you need to do is flip back to the 30s, the 70s, the 80s, after 9/11, the financial crisis of 2008, even COVID. If you look at it purely as a recession, it was caused by other elements. There are lessons to learn from every single one of those. And that is what we're going to start looking at and seeing, what does that inform us about value investing? There is one part of the economy that has not happened before in the United States, at least to this degree, and that is the potential for a debt ceiling issue causing a default. We have come close to it. We have come to even a credit rating downgrade, as you may remember, in 2011. And then in 2013, there was the other close call. However, every story that you read indicates that we live in a different world of extreme differences between the parties, where to think that one of them is going to blink and assume that it is going to happen is no longer a given. So we need to make sure that we take that very, very seriously. Now, a couple of things. We can sit here and say, oh no, inflation is bad. We can sit here and say interest rates, who knows whether it's going to go up or go down. Is there a recession? Is there a debt ceiling issue? Rather than complaining about it and saying, gee, Chairman Powell should do this, or Janet Yellen should do that, or the Republicans should do this, or Democrats should do that, you and I do not have control over any of it. All we have control over is what can we learn from history, what are the logical things we can do. And so my appeal to myself and to you is that we're going to take what we have and make the best out of it. So let's talk about a plan. We're going to look at what history says from previous recessions. We're going to look at each sector. We're going to look at each industry, pick out those that tell us a story. We will then start looking at currencies under threat in the past and the present, see what happened when other countries defaulted. How did that affect equities? Were there any exceptions to equities that performed even when the country was in threat? So it's things like that we're going to look at to understand how do we become smart investors. So without much ado, let's start looking at value investing. What is it and what is the definition? The definition of value investing is the simple premise that the market does not price securities properly. There is money left on the table, so to speak, in some cases where the market is undervaluing a security. And you and I know, and I don't want to mention any security names, there is a lot of hype. So you could type AI anything today, and that thing is valued at an enormous number. A few short months ago, crypto anything was valued at an enormous number. Overvaluing is far more common than undervaluing, and it takes a lot of research to identify undervalued assets, and the value investor precisely does that. So we're going to use objective measures, not feeling, not I went to this one store and I like the taste of that cookie and therefore I'm going to think it's good. We're going to look at specific objective measures to identify underpricing. Then Warren Buffett, in one of his original books, says he calls this the discarded cigarette butt. And it's an awful analogy, but it is what it is. He says, you would find the discarded cigarette butt on the ground. The original owner of the cigarette butt has thrown it away. They have no further use for it, but it still has one or two puffs left in it, and those puffs are free. So you could acquire that asset, which is underpriced, it has been discarded, it's free, and get two puffs out of it, and that's free value. He subsequently changed his definition, and he calls it the hidden gem now, thankfully, much better analogy, wherein he says there are plenty of assets. In that big pile of stone is one gem. And if I can understand how to pick that one gem, then I'm a good value investor, and that is what we're going to teach ourselves to do. Now, how do you identify hidden gems? The very common things you read about are PE ratios and return on assets and return on equity, and that is already at a single security level, meaning what is the PE ratio of company XYZ? By that time, you've already assumed somehow that company is the company that should either be bought or not bought. And before you do that, I would humbly argue that you need to look at the macroeconomics and say, should I even be in that industry? Another thing that a value investor shuns is stuff such as there is a cup and a handle. What I mean by that, and if you don't know that terminology, I'm happy for you. But if you do, here is generally what it says. If a particular equity trades at 100 and it has now dropped to 80, we should all buy it because that security never goes below 80, and there is resistance and it's going to come back to 100 and there is free money for you. And this is all based on statistically where things trade. And a value investor doesn't believe mathematical patterns or what control the value of a company. A value investor looks at economics, the company specifics, other global events, and so on. And so we're going to start from the basics. We're going to start by understanding what moves the needle at a very broad level. Look at past recessions, look at past events, and come back from there to the industry and the sector, and then go from there into the individual equity. All right, before I go into looking at the past, we're going to be using a whole lot from the Federal Reserve, the Bureau of Labor Statistics, And I posted the link here, but you should be able to Google fredblog.stlouis.org and see everything I'm about to show you here. It's a wonderful read. And it is going to show you two plots. One is called the CPI, which is the blue line, and the red is called the PPI, which is the producer price index. And generally, here is what it says. If I took a shopping basket and I always put a loaf of bread, a pint of peanut butter, a bag of chips, and a movie ticket, and I went back year after year after year and kept trying to buy the same thing, and I noted down how much I spent. Let's say it cost, and I'm making up numbers here, $8.28 to buy that in the year 1980. I'm going to call that a basis of 100. And then I'm going to measure from 1980 on every year how much did it cost as a ratio of $8.28 or whatever it was on 180. And so the 100 is the baseline for 1980, and it might go up to 101 if that same basket cost 1% more, or it comes down to 99 if that same basket cost 1% less. That is CPI. PPI is the producer of that. It used to be called the wholesale price index. But how much did the person one step farther in the supply chain have to spend to do the same thing? So, as you can imagine, if the one step before the consumer spent more money to acquire the goods, they are going to attempt to pass that price increase to the customer. PPI happens in the world earlier. If you think about things that are imported, for example, the container of merchandise arrives in the port in March, in a hypothetical example. If the purchaser has already paid $1.10 instead of $1 last year for that particular container of goods, by the time it shows up in the retail store, you can imagine a 10% higher price. So a PPI is a predictor of the CPI in general terms. As you can see here, the PPI goes up and down. When the producer price decreases, they don't pass along a lot of the savings to the consumer. How interesting. But when the producer price increases, they do pass along a good amount of that to the consumer. The only time producer price and consumer price has gone in sync was during COVID. It didn't matter what it cost you to make food at the restaurant when the restaurant is closed because you couldn't go eat there. In theory, your cost of that meal was dramatically lower. And so the idea that is being shown here is that you should be able to look at PPI trends, CPI trends from the past during recessions and understand, I wonder how it affects me today. Let me give you an example. What we really are looking for is when the country's GDP grows, its purchasing power grows. And so what I mean by that is your grandpa may have only made $50 a month in salary and paid 10 cents for a movie ticket. And you sit here and say, oh my God, movie tickets are now $10 and I'm paying 100 times more than grandpa. Well, as long as your salary is 100 times more than grandpa, as a percentage of your salary, you're okay with movie tickets. That is the general premise. As GDP increases, it should act as a lag on the inflationary effects. But remember what is happening today. GDP is not increasing by as much. It's barely increasing. During a recession, GDP is decreasing. So you do need the CPI to come down. Instead, if the CPI is up by 6% and inflation is up by 6%, we're in big trouble. What it means is when supply is constrained, and this happened during China, supply chain, whatever the excuses that were given, some of it were real, some of it were not real, bird flu, when the purchasing price increased, the cost increase came straight to the consumer. And when demand decreased, and it could also happen if there is a lot of competition, purchasing price index decreases. For example, if nobody could go out and buy cars in the middle of COVID, maybe you got a really good deal on cars. Well, if everybody started buying used cars, then demand increased and the price of used cars went through the roof. And so, in general, there should be a pull and a push in terms of increase in demand and decrease in demand, but it's not always linear. So what we are looking for is sectors of the market where the PPI does not go up and down to a great extent during a recession, because you don't want to be a speculative investor, you want to be a value investor. You want to be in one where purchase price is steady and consumer price is steady. If you can do that, you've found the right sector to then dig deeper to understand where to do value investing. So let's look at a couple of examples. Gasoline. Everybody thinks of gasoline as a very volatile product, and it is. If you look at what happens during gas prices during recessions, look at that. It craters during recessions. Why? The idea is that demand has decreased. Gas stations sit there with giant containers of gas. People don't use it because they don't have jobs, they're not traveling, they're not doing stuff, and the price keeps decreasing, except in the 1970s and the 80s, when the recession itself was caused because of a gas price increase. So in general, gasoline is a very volatile area where the PPI decreases during recessions, unless, of course, there is a geopolitical reason why the PPI increases. And off late, the US is a net producer of gas. And so the global factors don't affect us as much, but the local factors do. So here is an example of a product where the volatility is rather high. This isn't a good value investment unless a couple of other things are true, and we'll talk about that. But bottom line, we are looking for a flat linear line there, and gasoline doesn't fit that at first blush. How about manufacturing? It goes without saying, when demand is less, you should be manufacturing less. Surprise, surprise. The 90s, we had an up and a down. In the 2000s, this is 2001, 9/11, manufacturing goes up and down. There was some wartime manufacturing there. The financial crisis saw a huge drop. COVID saw a huge drop in manufacturing. The point again is that when there is a recession, demand decreases and manufacturing activity, the PPI decreases. And so if you are invested in the manufacturing sector and there is an impending recession, the odds of your getting steady dividends, the odds of the present value of future earnings, remember that is the definition of stock price, the odds of a present value of future earnings being high is very low in manufacturing. So the thing that we want to look at is again a flat line, the elusive flat line. So how about cancer drugs? What does your instinct tell you? Do you think when there is a recession, people stop taking drugs for life-threatening diseases? Surprise, surprise, of course not. So when there are life-threatening illnesses involved, it doesn't matter whether there is Lehman Brothers or financial or COVID, the demand for life-threatening drugs is always there. The PPI is always there. And this is an industry where, in theory, you couldn't go wrong, except we're going to introduce some wrinkles there as well. But this is kind of what we are looking for. This is closer to the target than otherwise in terms of value investing. Now let's talk about natural gas. Natural gas is very closely connected to gasoline. You would expect something very similar to happen. Let's look at what's happening. Before the US was a net exporter of natural gas, we had the same problem. When there was an energy crisis, natural gas prices would skyrocket and create further problems. Here is something very weird. During recessions, natural gas prices come down very, very sharply. Look at this. It goes from an index of 500 to practically 100, a 5x decrease in natural gas prices. Why do you think that is? In other words, why is natural gas shunned during recessions? If you thought it is your house and you somehow cook less, or you somehow, the restaurants cook less, you are wrong. The residential use of natural gas is not a big driver of natural gas consumption. In the post-fracking era, natural gas is consumed more in the production of steel. And so Steel producers in the past and today, when there is a recession, they tend to switch to coal as a source of energy. And it's not just steel, many of the heavy manufacturing, they tend to burn coal. However, as you know and I know, that between 2008 and today, there is a very big difference. Watch what is happening. Watch what COVID did to the price of coal. It just shot it way up. And so then part of the reason is American coal is being exported to Europe because there is a huge demand in coal from there. And that's what I meant by you can't only look at your own country, you have to look globally to understand what is going on. But natural gas prices decrease and coal prices increase. And yet again, this isn't exactly what we are looking for. There is too much volatility in one direction or the other. And I'm going to show you my favorite chart, which is rock salt. What is happening in salt? During recessions, it goes up. During normal times, it goes up. During COVID, it goes up. Salt prices never come down except this anomaly here for 1 quarter, and I don't know what happened there. And there is a very interesting reason why. Think about it. Lehman Brothers crashed. Are you going to salt your omelet less? Financial crisis. Iran-Contra affair, war. How is your use of salt going to change? There is really no substitute for salt. It's not like you can turn off natural gas and go to coal. Once you stop using salt, your tongue starts saying, I better go get more of that. What we are looking for is patterns like rock salt, patterns that have a very steady movement and not a lot of up or down, in terms of the PPI or the CPI. Those are the good value investment areas. So how do we create a framework? We have to take what is happening today into account. The Ukraine war and gasoline actually has been better for the stability of gasoline prices and the PPI. Yes, gas prices are lower. However, unfortunately, until there is still the threat of the war, the US reserves are lower. There is always the opportunity that we will need more gasoline. Production capacity is being lower. There are fewer oil wells being dug. And so the odds of oil prices crashing are lower. And so you may not see the same pattern that you saw in the past in gasoline prices. So that is a counter indicator going on today compared to past recessions. Natural gas. The path from where we are to quote clean energy runs through natural gas. Natural gas is considered cleaner energy. And so the economy is happy to say we don't use coal, we use natural gas. And so the demand for natural gas is not likely to go down to a very low number, even when there is a recession, simply because there isn't a lot of coal available. The coal that is available is being shipped to Europe. And so natural gas is probably not going to behave the way it behaved in the past in terms of recessions. What about cancer medicines? Is the answer to go buy every pharma company that makes cancer drugs and say, I know it goes up all the time? Even there is a lot of innovation. There are personalized drugs, biologics as they are called. There are many biotech firms. Look at the most famous investor in value, Warren Buffett and Berkshire Hathaway. Look through and you tell me how many biologics and how many cancer drug making companies they own. The answer is zero. And here's why. It is too hard to know which particular drug is going to win when they are far earlier in the clinical trials. And once they go past the clinical trials, they trade at a really high premium. And so investing in that area doesn't perfectly suit the value equation either. And so you need to take the data as lessons, but then you need to use your own intuition, the economy today, the global factors to come to the decision. So what are the lessons? To find the rock salt in the world, we are looking for really big barriers to entry. You cannot live without salt. How beautiful. You need to look at within that sector, how do you perform versus competition? And you need to create a framework to analyze one company versus another That doesn't mean you go out and buy every rock salt manufacturer in the country. Even within that, you need to look at financial stability, you need to look at competitive positioning, and so on. And so, in the next episode, we're going to get to that. We're going to, before we even go to the individual equity and look at sectors, we haven't addressed the elephant in the room, which is what happens when there are sovereign debt fears. And so, we're going to look at a couple of case studies there. And then we're going to look at which sectors behave and don't behave during a debt crisis. And I'm going to introduce a fictitious country called Saint Neldangi. And there is a reason why that country has that name, called Saint Neldangi. And this country ran out of spinach during a currency crisis. True story, but the country name is masked. Saint Neldangi. We're going to dive deeper into Saint Neldangi, look at what happened to their currency crisis, look at what happened to their supply chain, look at what happened to their groceries, look at what happened to various sectors. So come with me on that. And before you forget, the best bet, even today, until the debt ceiling blows over, is to buy short term treasuries. Wait for the debt ceiling drama to be over. In the meanwhile, keep learning about value investing. Thank you for listening. And if you have any additional comments or questions, I welcome an email to yieldnerd@gmail.com. Have a nice day.